Joining us now, UBS Senior Vice President of Wealth Management, Jim Lacamp, and Bonnie Wongtrakool is a portfolio manager at Western Asset Management. Good to see you both, Jim. The headline of the day that seems to have sparked the rally overseas and here in U.S. stocks is that China indicates it's not going to retaliate for now, and talks are ongoing with the U.S. on some sort of resolution. As a portfolio manager, does that give you confidence? Where do you see the trade war?
Sarah, nothing has really changed here. I mean, we've had a lot of these little head fakes, little ebbs and flows on trade. Sometimes it's a tweet, sometimes it's something out of China. But until they really start addressing intellectual property theft and technology transfers, nothing really is going to change there. The other thing that hadn't changed for the market is the market's been trading in this range between about the 150-day moving average as support for the S&P 500 and the 50-day moving average as resistance, just kind of trading in that band. And so we've had some violent consolidation going on, but at the end of the day, nothing's really changed there. And beyond that, when we get to the economy and the yield curve, because the yield curve has gotten a lot of language here lately, the yield curve may be a reflection that the U.S. government bonds are yielding higher than almost anywhere in Europe, higher than Japan, almost all of which are negative rates in these areas. So the U.S. Treasuries may just be a bargain here relative to the rest of the world. So I think what we've got is seasonal trading here. August, September is typically a little weak here. And then what we should settle down by the fourth quarter. You should see the market start to rally again.
Bonnie, I mean, you guys are a big bond shop over at Western Asset Management. How do you see this move in August, this flood into treasuries, the inversion across the yield curve? How much of it is flashing red to you guys?
Right. So as bond specialists, we're clearly watching the yield curve very carefully, all parts of it. But we're looking at that as one of many factors. And at Western Asset, we think it's really important to step back and look at the fundamentals and what the market is pricing in versus those fundamentals, and not get too caught up in the many headlines that are barraging us these days. And when we look at the fundamentals, what we're seeing is an economy with consistent job growth, with modest wage growth, with positive earnings growth at corporations, and economy growing at 2%. And most importantly, a Federal Reserve that is very willing to support that growth and maintain the financial conditions to extend the recovery. So we're not seeing the recipe for a recession, notwithstanding what the yield curve is saying, which of course is important, but when you look at it against the other factors, is not dispositively flashing red. I think the other thing to mention with respect to the yield curve is that negative rates globally have really had an effect on Treasury yields here. You know, there's $16.7 trillion in negative yielding debt globally. That is a big deal and something that we hadn't seen historically. In fact, the Richmond Fed actually put out a paper last year, and members of the Fed have been looking at this effect, and it showed that the probability of inversion does go up because of these negative yields, even if the risk of recession doesn't go up. So How we've played this is that we think that because recession is not imminent, the Treasury, 10-year at 150 is pricing in too much negativity. And so we've been sellers of duration into this rally, and we've been holding credit selectively.
All right. Yeah, you got to the very end there in terms of what you're actually doing, which was going to be my question. But is there any expectation on your part that negative rates that we're seeing, the $16.7 trillion you just referenced, Bonnie, is going to change anytime soon in so much of the world?
Unlikely, because we think not just the Fed, but global central banks are all very cautious here. They want to maintain accommodative monetary policy. They're very cautious. They don't want to have to come and rescue again, so they want to maintain positive conditions. So it's unlikely that yields are going to rise from here, not just because of the central banks, but because inflation is really remaining low. And until we see inflation rise, which we're not expecting due to structural forces, we're not going to see any rate hikes by central banks.
Jim, you've referred to how we're in a little bit of a neutral spot in terms of the overall market. If you look at the indexes going sideways for a few weeks now, but within the market, there's been a lot of divergence. Where would you look to position in terms of whether the kind of more beaten up areas, energy, financials, some consumer and industrial, or do you think that this sort of quality defensive trade that benefits from very low yields is going to continue?
It's a great question. I think you're going to want to focus on quality and growth. Why growth? Because, look, we've had ultra low interest rates for 10 years now. They don't appear to be going up anytime soon. That's driven up real estate prices. That's driven up stock prices. It's driven up bond prices, of course. And so you're going to have a harder time getting that growth moving forward that we've had in the rearview mirror. And if that's the case, then I like companies that can grow in this environment. I like companies also with a bit of a dividend, because the dividend yield now in the S&P 500 not only is higher than the 10-year Treasury, it's higher than the 30-year Treasury. So I think dividend stocks are going to be okay, but I really want to focus on growth areas. And you can use the volatility that you've got right now to buy on support and get rid of some things maybe you don't like on rallies. Now, a lot of people are focusing on the financials here, saying they're cheap. But look, with a really, really flat yield curve across all durations and no expectation of rising rates anytime soon, I think it's going to be very difficult for the banks to have a sustained rally. So I'm not too crazy there. I'd rather focus on growth and or stocks that have a potential to consistently raise their dividend here.
Bonnie, the Treasury Secretary has floated this idea that the administration is again considering the prospect of a super long bond, 50 or maybe 100-year Treasury. Do you guys think there would be demand and something like that could be a successful way to handle the deficit and take advantage of lower interest rates?
Well, clearly it makes sense for the Treasury to investigate this, given the low interest rates and locking in that financing. It all depends on the valuations at which they come. And so when and if that bond issuance does come, we'll take a hard look at it and make a relative value decision.